Javi Plantation House, and I'm Charles Biderman. Welcome to the initial broadcast of Charles Biderman on the Markets. I plan to do a show interviewing several of the brightest and best people in the financial world every so often, starting initially fortnightly and maybe going to weekly. I plan to have people who you want to know what they really think, and you want to know who they are and have a good sense of them. That's what this show is about. For example, right now, what's really going on in the markets, today's the day that Trump is going to do his State of the Union address, and also this morning or overnight, Amazon and Warren Buffett announced that they're planning a new healthcare initiative to reduce costs in being the middleman in our healthcare system, which is a big deal, and it did drive markets down, and the markets have been down for a couple of days here. But as I've been saying all along and on the air with Rick Santelli regularly, who is also the first guest today, that as long as the central banks keep printing money with which to buy financial assets, prices will go up until they stop printing money. So while the markets are down here, there was a lot of year-end money went into the markets at the beginning of this year. It's gotten way extended. We're seeing individuals now pumping money into the markets. So I think we could have an extended, and also today is the last day of the month. Typically the markets are weak the last week of the month, and as the new money comes in at the start of the month, which would be Wednesday, February 1st. So I'm short-term bullish. Long-term, when the central banks stop printing, I think we're going to be in major trouble. We're going to have a very volatile market, and it'll be fun watching like exciting or interesting, not fun, haha, isn't that great, watching all this unfold. Thank you for being here, and thank you for watching. Hello from Javi, Hawaii, and I'm Charles Biderman. Welcome to Biderman on the Markets. My guest today is Rick Santelli, who needs no introduction. Rick is the most popular, in my opinion, hosts, anchors, on-the-air personalities, whatever you want to call them, for CNBC and for any financial news person. Rick has the highest approval ratings, that I'm aware of. And Rick, why are you so popular with your viewers?
Well, I'm not sure I can speak for my viewers, and I thank you for those kind words. But I suspect, at least what I try to do, and it seems to resonate, is when I look at the markets, and I've been involved in the markets in a direct primary relationship since the very beginning of 1979, so I try to call it the way I see it. I don't try to look at the market through a lens of politics, through the lens of who the president is, who the president was, who takes control of Congress. I look at a market and I try to ascertain why it's acting the way it is, why investors are thinking the way they do. I try to look at history to put a face on it, because I'm rather fond of technical analysis along with fundamentals and macro analysis, because people behave the same, no matter if it's 2,000 years ago, 20 minutes ago. The emotional roller coaster attached to trading and investing in markets causes certain responses in those who invest, and there's a repetitive nature to some of those responses, and I try to call it the way I see it. And one thing I will say, Charles, there's always been politics in every aspect of our lives. After the credit crisis of '08, my observation is that it's ramped up 20-fold, that everything about the markets, why they move, who's responsible, is it because of this president, that president, that it's gotten to the point where the politicized observations of why markets move is really, I think, not well received by those that are just pretty much thinking about it, not the politics. And I think the same can be said for many of the sports we watch or the award shows we watch. No matter what side of the political spectrum you're on, it's now invaded just about every aspect of our lives. And in particular, when it comes into the domain that I base my hobby and career on, markets, I don't tolerate it. I do as I see fit, and I try to be a straight shooter. And I think that's why I seem to resonate in a positive way with many who watch.
Well, I think what both of us do, in my opinion, is that we both talk about what's really so, as opposed to what people think and their opinions about it. I mean, to me, the news that you cover and the news that I try to, I mean, my whole research, my whole business career has been based upon making money, telling people what's really going on now. And if smart people know what's really happening in terms of money flows, in terms of supply and demand of stock, bonds, money, they'll know what to do and make money from it.
Absolutely, Charles, and you've done it in a way that's very unique, and that's where our relationship began, by monitoring the flows. It brings to mind somebody screaming, follow the cash, watch the money. And when it comes to markets, it's no different. No matter how a money manager talks, the only thing that really matters to us is where his money goes.
Exactly.
I think that's quite important, and especially in the context of something as glaring as what happened on November 8, 2016. When this president was elected, no matter if you liked him then, like him now, don't like him then, never will like him, it doesn't matter to me. I think that what happened that day transcends the man. We went from a world of financial repression with the top of the pyramid elites around the world thinking they were smarter than markets, and they wanted to take over how to allocate capital to where. They wanted to pick winners and losers, and it's just never going to be appropriate. And I think that what happened on that day, if you get a chart for any market in the U.S., it's infallible proof that pro-business is the reason this administration had such a big welcome in the markets. And I think that's a profound statement if people really think about it.
Well, as you know, when I was on with you right after the start of the year, I personally do not admire or respect our president personally. However, the fact that he lightened the load on regulation and created a sense of business optimism from the beginning of 2017, I was surprised to see the real-time data I track showed the economy picking up well ahead of what anybody was seeing. And as we talked on your show, to me, we could have a global pickup in the economy and a global bear market in equities and bonds by the time of the midterm election.
No, it's a valid point. And the real difficulty here, especially for you and I, trying to look at the markets for what they are, trying to think ahead for what they may become, gets so much more difficult because of what happened on that day that I referenced, the election day of 2016. In my opinion, it was a Cold War between governments and business, and it ended. But what didn't end on that day was all the policies that the Cold War wrought on central banks.
Yes.
When you think about it, central banks had to make up for the boot on the neck of business and try in some way to keep the economy humming. And the way they did it, we can debate should they have done it, but they did. And now that the Cold War is over and the markets are actually have a life of their own that's real and tangible, it really makes the central bank mission very difficult because it happened so quickly. It was such a binary scenario that now central banks have to try to figure it out, and they need to move fast. And one of those areas, which I've discussed with you many times, and it was the feature of one of my spots today, is the yield curve. The Fed balance sheet, even with balance sheet reduction, and granted, it's just underway, and it's going to pick up some momentum as these numbers start to add up. But right now, the balance sheet is only $11 billion smaller than it was a year ago.
Yep.
Last Thursday, every Thursday, the Fed balance sheet comes out, 4.41 trillion. Okay, 11 billion less than a year ago. The point is that if they continue to raise rates with this parlor game of 3, 4, 2, think about it in terms of if they're going to add 75 to 100 basis points on the short end, are these maturities going to all start to roll over each other and create an inverted curve that historically makes investors nervous? It's going to be even more complicated as things normalize.
Well, I think there's a bigger picture analysis here that I'd like to add to exactly what you're said is actually what's so. But from the bigger picture, I doubt that there really is a plan that central banks have other than the central bankers keeping their job until their term is over and they either get reappointed or can retire with a nice government pension. I don't think they have a real clue as to how to exit this without destroying the markets. They're just hoping that they can push it off. It's sort of like China. China keeps creating money that they spend on projects that no one's ever going to use. And as long as they print more money to pay the debt service on those loans, China will keep chugging along the way it is. And, and who knows how it's going to end. To me, the central bank situation here is they're printing money. Yes, like you said, the Fed says that they're tightening, but they're not tightening. They didn't tighten very much, as you pointed out, 11 billion this year. But meanwhile, the Japanese central bank and the European central bank keeps printing money. So yes, long rates are going up a bit, but a bit. It's still not like a surge.
No, they can't break through the gravitational field of what's holding them back, in my opinion, some of the inventory around the globe of central banks and their sovereign debt. But the pull of the short end is there's direct relationships between the Fed raising of rates, now that it's 125 to 150 from 0 to 25, that can't be argued with. And how that filters through the curve is going to have huge ramifications in every market because cost of capital is being repriced. And what's more, Charles, we don't know if there is a possibility even of taking all of this crisis era policy away without damage to the market.
Well, I don't think
I'm not saying it's impossible. Maybe it can happen. And the only way it can happen is through big explosive growth that overwhelms it. But I completely agree with you that the Fed and the central banks of all the developed economies, whether it's Japan or the Eurozone, don't have a big plan. And there's some proof of this. First of all the rationale for what plans they've created to get us here were wrong. Janet Yellen and Ben Bernanke were absolutely stalwarts on the notion that what was going on in many areas of the economy was cyclical.
You mean that economists?
Wrong. It was structural. So all the staff they applied, sadly, that put us in a predicament where it's hard to unravel, may not have made any difference to the areas of improvement, like unemployment getting smaller. These things are like the sun coming out every day. But yet, what they did, thinking that their policies were directly correlated with that, when there were so many other issues going on, that's a little bit frightening.
Well, I don't think that they really thought anything other than, well, this is what everybody thinks, and I'm going to go along and say this is what's so because it's a consensus. And a consensus of economists predicting anything, the odds, as the actuality has shown, the odds are heavily, like 95%, that they're going to be wrong anytime you get a consensus of economists predicting anything. One of these guys have never made a living that wasn't salary generated. They never created profits. How many of these guys actually went to Wall Street and made money with their ideas for clients, trading them? None of them. That's why they're central bankers. So anyway, let me come down to me, the most important question that we have facing us. The U.S. stock market bottomed at $9 trillion in overall market cap in March of '89. It's now $30 trillion. So we've had like a triple. Global market cap is up like $50 trillion from the bottom to over $80 trillion. And the coincident indicator is that there was a 15 trillion, I forget the number, I think it's 15 trillion increase in central bank balance sheets.
Yes, that's the number I'm aware of as well.
And so as the balance sheet grows, the market value of stocks and bonds, and we didn't talk about the value of bonds, I don't think there's any single number for the value of bonds, but it's probably a greater than an 80 trillion increase. So we've had all this leverage increase. So the real inflation, history is going to say this is the most inflated era for equity prices and bond prices because of central bank money printing. I say that as soon as this money printing stops, the markets are in peril, major peril, like we haven't seen in quite a while, particularly the global bond markets, which I don't think the European banks, sovereign banks, can survive without the ECB buying all their new paper.
No, and on that last point, point, I think I know the outcome, because it's the only possible outcome. Mario Draghi is leaving in 2019, and the next rotation dictates we're going to have a German that's going to be in charge of the ECB. The Germans been bankrolling much of this.
And they have a budget surplus, Rick.
What probably is going to happen is they're going to create a Eurobond, whereby the German curve ends up being the only curve, the only paper, and basically they're going to sweep all the other securities under a rug. They've been giving full collateral to, which is the reason why certain southern economies, 10-year notes like Spain, to some extent Italy, have been so low. I mean, anybody who looks at the yield curve of these southern economies of Spain on the of Europe on the long end would think, well, why would their rate be lower than the U.S.? It makes no sense. Well, it doesn't make any sense.
Except,
and I think that alone is going to offer investors an ability to make some good money on some of their trades. But I think I would look at it this way. Let's look at the worst case scenario. So when this administration got in, the stock market was roughly 18,000. Right now we're coming back down towards 26,000. I personally think the 18 up to the 26 and change is based on the real deal. I think much of the run-up from about 11 or 12,000 to 18,000 wasn't as real, mostly built on sand during the Cold War of business with the previous administrations. So the worst-case scenario, I think, is we hold on to everything after November, we give some back. So even if we gave up 4,000 or 5,000 Dow points, we're still going to end up better off. So it's a shock absorber. Is that palatable? Investors? No, they'd rather not have it. But I think that the move that we've had in a pro-business environment with tax reform, potential immigration addressed after decades of neglect, I think these are real things that are creating real economic benefits that are going to pay dividends with more GDP for years to come. And I think that shock absorber will cushion the inevitable correction that you seem to be looking for.
Well, Rick, I hope you're right that there will be a shock absorber. I agree that the economies, the global economies, the U.S. economy will continue to grow and do well. But I really think that the decline in top line value when money printing ceases and there isn't this fake news buyer or fake buyer of those who produce money with which to buy financial assets like the Central Bank of Europe and Japan, I think margin calls are going to decimate the equity markets. I think there's everybody who's on your air really believes, almost everybody, that they've made $20 trillion. The markets in the U.S. are up $20 trillion, and they deserve it because they're smart, good people. And it's not going to go back to 15, 20 trillion.
Now, and one other thing we've avoided, that it's also like a game of musical chairs. And I do give credit to our central bank for reversing course and trying to get back to pre-crisis handling of monetary policy. And in the musical chair analogy, the fact that the ECB and the Bank of Japan, and to some extent the Bank of England, have been reticent to be so aggressive in going the other direction may mean that we become the home base for investors fleeing those other markets.
Could be.
We were first.
Could
and
be.
I think that also offers a glimmer of hope.
It could be. But again, margin calls is the big unknown. You don't know what's leveraged, what could start.
During those moments of emotional tension where you get major repricing, we all know investors trade and liquidate first and think about it later. Yeah,
and particularly since there's, we can talk about at some other point the risk to the market of all the money in passive investments. So if money stops going into the SPY and other similar,
the ETFs will be much more.
No. But my point is
sure.
When the money stops going in and there are outflows, who's the buyer? There's no buyer if there's no managed funds.
No, you're right. And the one that comes to mind, and I'm only picking it as an example, I'm not saying anything dire is going to happen, but when you look at the HYG and you think about all the securities, high-yield securities that had to be purchased in that index that probably wouldn't have found buyers, you're right. When it reverses and all those securities go back into the marketplace, on good days, some of those securities couldn't find a home. Who's going to buy them in liquidation mode? And see, this is the dark side, I think, of some of the way the ETFs are set up.
So the one thing I want to end with, and it's a self-promotion, I'll admit this in advance, that in volatile markets where you're concerned about what's really going on and potential margin calls, you want to own companies that are growing free cash flow and using a portion of that free cash flow to reduce their share count while maintaining stable balance sheets and strong balance sheets. And company or portfolios of companies like that, I can think of a couple, but I won't mention it for FINRA problems here. I would invest in those in these volatile times and hope I'm wrong that there won't be and I hope you're right that there is some cushion here.
Yeah, no. When everybody's forced to sell their cars cheap, buy the luxury cars that sold for much more than you're paying for them currently, I couldn't agree with you more on stocks.
Rick, thank you so much. Look forward to our next hit on the Santelli Exchange in a few weeks. And thank you again for playing with us here on the Biderman on the Markets.
My pleasure. It was an honor to be your first guest.
Thank you, Rick.